90% of Bitcoin holders are going to make the same 3 mistakes on the next crash that they made on the last one. Not because they are unintelligent, not because they do not understand Bitcoin, because nobody ever sat them down on a calm day and showed them exactly what those 3 mistakes look like from the inside before the moment they actually needed to know. You are about to spend 13 minutes doing something almost nobody does before a crash instead of during one. We are going to walk through the 3 specific failures that wipe out otherwise smart, patient holders using real data from real crashes, not theory. And by the end, you are going to know exactly which one you are currently exposed to, right now, today, while the market is calm enough to actually fix it. Here is why this matters more than most people watching realize. Every single one of the 3 mistakes in this video has already happened, in full, on camera, in Bitcoin's public price history, more than once. None of them are hypothetical warnings dressed up to sound scary. They are documented events with dollar figures, dates, and outcomes you can verify yourself, and the only real variable left is whether you fix your own exposure to them before the next one or after it. Here's the first mistake, and it has nothing to do with Bitcoin itself. It is about how much of it any one person owns relative to their own ability to sleep at night. Most people who panic sell during a drawdown did not change their mind about Bitcoin. They changed their sleep, and the position size, not the thesis, was the actual problem the whole time. There's a simple test almost nobody runs before they need it. Take your current position, imagine it falls 70% and stays there for 3 full years, and ask one honest question: do you still sleep? If the answer is no, the position is too large for the specific person holding it, not too risky in some abstract sense, and that is a completely different problem with a completely different fix. Here's why this matters more than people think. Almost everyone who has ever panic sold at the bottom would have comfortably passed a smaller version of that exact same test. They did not need a different asset or a different strategy. They needed less of the same one, sized to a number they picked on a calm day instead of a number the market picked for them during a crash. Picture 2 people who both believed the exact same thing about Bitcoin, at the exact same price, in the exact same month. One of them put a modest slice of their savings in, sized so that even a 70% drop would sting but not derail anything else in their life. The other put in nearly everything they had liquid because the conviction felt identical and the upside math looked the same either way. When the drawdown actually came, the first person did nothing because nothing forced their hand. The second person sold near the bottom, not because their thesis broke, but because the dollar amount attached to that percentage decline had quietly become larger than their mortgage, their emergency fund, and their peace of mind combined. This is exactly the kind of decision that has to be made before the crash, not during it, because during it, you're not thinking clearly anymore, and that is precisely why the Bitcoin Holder Bible exists as a written document instead of a feeling you try to summon at 3 in the morning. It walks you through this exact sleep test with your actual numbers, so the decision is already made and already written down before the market ever tests you on it. It is $27, one time, no upsell, no subscription. Link is directly below if you want to pull it up while we keep going. Because the next mistake is the one that has already produced the single worst forced selling event in Bitcoin's entire history. Now, the fair counter-argument, because sizing yourself down to guarantee comfort has a real cost too. A position small enough that a 70% drawdown never bothers you at all may also be too small to justify the attention, the tax complexity, and the research it takes to hold responsibly. And there is such a thing as an allocation so cautious it becomes a hobby rather than an investment. The sleep test is a ceiling, not a target. It tells you the largest position you can carry through a genuinely bad outcome. And where you actually sit below that ceiling is a separate decision that deserves a clear head, not a test alone. On October the 10th, 2025, the crypto market lost more than $19 billion in leveraged positions in a single 24-hour period, according to CoinGlass data independently reported by CoinDesk, CNBC, and Reuters. More than 1.6 million trading accounts were liquidated. Bitcoin fell from around $118,000 to roughly $101,000 in a matter of hours, and total open interest across major exchanges dropped 43% as positions were forcibly closed, whether the people holding them wanted that or not. Here is the mechanism nobody explains clearly enough. A liquidation is not a choice. It is an automatic, forced closure of a leveraged position the instant its collateral falls below a required threshold, with zero input from the person who opened it. Leveraged traders cluster their positions around similar price levels because most people use similar leverage relative to the same recent highs and lows, which means enormous pools of forced sell orders sit stacked at specific, identifiable prices long before the market ever reaches them. That clustering is exactly why cascades happen. When one cluster fires, the exchange sells the position into the open market, pushing price down into the next cluster, which fires those positions too, and so on, in a chain reaction that no single trader controls once it starts. This is not a conspiracy theory about manipulation. It is a mechanical property of how leveraged markets are built, and you can verify it yourself by reading any major exchange's public liquidation documentation. An unleveraged holder and a 70% drawdown has exactly one advantage that is worth more than anything else on this list: the ability to do nothing at all. They can be wrong for 3 years and simply remain in the position while being wrong. A leveraged holder cannot be wrong for 3 hours past a certain point, because there's a price at which the position closes itself automatically, and no amount of conviction changes that outcome by even $1. This is not the first time this exact mechanism has broken the market either, which is worth knowing before you assume October was some unrepeatable outlier. On March the 12th, 2020, now called Black Thursday, Bitcoin fell from around $7,900 to below $4,000 in about 24 hours. And at one point, BitMEX's entire order book held only around $20 million in buy orders against roughly $200 million still waiting to be liquidated. There was, for several dangerous minutes, almost no liquidity left in the market at all to absorb the forced selling. 2 separate crashes, 5 years apart, driven by the identical mechanism each time. This is precisely the gap between a holder who has a written liquidation and leverage framework and one who is improvising through the worst day of the cycle in real time. The Bitcoin Holder Bible has a specific worksheet built around exactly this, walking you through calculating your actual liquidation exposure against public cluster data on a calm afternoon, so you already know the answer before the next $19 billion day arrives, not after. $27 gets you that worksheet along with everything else in it, no code required, link below whenever you want it. And the third mistake is the one that proves you can do the first 2 perfectly and still lose everything. Here's the fair version of the leverage argument too, because it is genuinely used well by some people. Leverage is a legitimate tool when it is hedged, actively managed, and treated as a live operational parameter someone checks daily rather than a distant hypothetical. And professionals use it competently every day under exactly those conditions. The distinction that matters is simple. If you cannot state your own liquidation price from memory right now without checking, you're not in that category, and this section was written for the other 90% of people watching who are not. Marcus never sold. He had the right position size, he never touched leverage, and he had a written thesis better than most of what gets published online. What Marcus did was leave his entire position sitting on an exchange, because that was where he originally bought it, and moving it always felt like a task for another weekend that never actually arrived. Here's the sentence that took this entire industry a decade of expensive lessons to fully internalize. An exchange balance is not the asset itself. It is a claim on a company that says it holds the asset on your behalf. And those 2 things are completely different right up until the moment that difference becomes the only thing in the world that matters. The record here is not theoretical. Mt. Gox suspended trading and filed for bankruptcy in February of 2014 with 850,000 bitcoins missing, at a time when it handled the majority of global Bitcoin volume. Celsius froze withdrawals from more than 1.7 million users in June of 2022 and filed for bankruptcy the following month. FTX collapsed in November of 2022 with an $8 billion hole in its accounts. Its founder was later convicted on 7 counts and sentenced to 25 years in prison with over $11 billion in forfeiture. In every one of those 3 cases, the sequence was identical. Customers woke up one morning, checked their balance, and found withdrawals suspended, not reduced, suspended, with the announcement always arriving after the decision had already been made internally by the company. And not one of those affected customers, sold. They made no decision at all, which was exactly the problem, because the danger was never in their hands to begin with. There is one detail from the Mt. Gox case worth sitting with, because it complicates the picture in an important way rather than simplifying it. Creditors did eventually get paid, with distributions beginning in 2024, which is the good outcome among these 3 stories. But that good outcome still took over a decade, through a foreign bankruptcy court, on a timeline decided entirely by a trustee, rather than by the people whose coins were sitting there the whole time. A decade without access to your own position is not a footnote. It is most of a retirement's worth of compounding gone, whether the money eventually comes back or not. This is the piece almost nobody plans for, because it does not feel like a Bitcoin decision at all. It feels like an errand you will get to eventually. The Bitcoin Holder Bible includes a complete custody checklist covering hardware wallet setup, recovery phrase storage, and the succession step. Almost everyone skips entirely, so that this specific mistake, the one that has already produced 3 separate historic collapses, is something you fix in one afternoon, instead of something you keep meaning to get to. $27, no voucher code needed because that is simply the price. Link is directly below, and here is exactly what happens if you close this video and do none of it. And to be completely fair, self-custody is not free of risk either, and pretending otherwise is how people lose coins a different way. The failure modes become entirely yours once you move off an exchange. A lost seed phrase, a damaged device, a house fire, a death with no instructions left behind, and there is no support line and no password reset for any of it. The honest position is not that self-custody is safe and exchanges are dangerous. It is that both carry real risk, they are different risks, and only one of them is a risk you actually control yourself. Nobody has ever regretted checking their liquidation price on a calm Tuesday. Nobody has ever regretted moving their coins off an exchange before they needed to. But plenty of people have opened an app during a crash, discovered their position size was wrong, discovered their leverage put them in a cluster, or discovered their exchange had frozen withdrawals, all at the exact same moment their judgment was at its absolute worst for making any of those three decisions correctly. That is the entire difference between the 10% of holders who make it through the next crash with their position intact and the 90% who do not. It was never about predicting when the crash happens. Nobody on this channel is going to pretend to know that. It is about whether the three decisions that actually determine the outcome were made on a calm day, in writing before the crash, or improvised in a panic during it. Notice something about all three mistakes we just covered, because it is the pattern underneath the entire video. Every single one of them was avoidable, with information that already existed publicly before the damage happened, the sleep test, the liquidation heat map, the custody checklist, none of it secret, none of it complicated, all of it sitting there for anyone willing to spend an afternoon on it instead of an emergency night. The 90% are not missing intelligence. They are missing a system they built before they needed one. You now know all three. Position size against your own ability to sleep, leverage against a public liquidation map you can check in 2 minutes, and custody against a decade of collapses that have already happened 3 separate times. The Bitcoin Holder Bible puts all three into one place you can actually work through today for $27, one time, link below. If this delivered real value, subscribe, because the next crash is not a question of if, and the only real question left is whether you are one of the 10% who already did the work or one of the 90% who's about to find out the hard way.